MTM here, and today I want to talk about the Trader's Dynamic Index. Now, this is a very powerful indicator that you can use in order to really help boost your profitability when trading. It has a lot of indicators that are combined into one. So, I want to take a look at what they are, how they can help you out, and see how we can go from there. So, the agenda will be about what is the TDI, how can you use it to become a better trader, entry and exit conditions, and then a live example showing you what it looks like here. So what we have is the Trader Dynamic Index, and this was developed early 2000s, and it was done because a man called Dean Malone wanted a way of effectively getting the best out of a lot of indicators in effectively one package. So within this TDI, you also have things such as volatility bands, relative strength index, as well as moving averages. Now, the volatility bands are these ones in blue over here. Then we have the market baseline, which is the yellow one over here, the signal line, which is the red one, and then the RSI price line, which is this green one. That typically will tell you what price is doing above when using this index over here. All right, so these volatility bands help us understand where the market makers, where the volatility is, and if we see movement above these bands, we're typically looking at a stop on happening in an area like this over here, or maybe this one down here. You see how it makes a little W shape? Typically, that would also happen in price as well, seeing as the RSI line is sort of parallel with the price line above. So we have a couple things here. So that's telling you volatility. That's the blue bands over here, the known as the Bollinger Bands. The green line over here is the market baseline. That's typically telling you the trend of the market that's happening right now. You also have the faster EMA, which is the green one, and then we also have the signal EMA over here, which is more of a longer time frame as well. Now, when we're combining this with price action, we can use the TDI to help traders like ourselves understand how to enter and exit the market. So here I have the price above and I have the TDI below. Now, there are also levels to look out for as well when doing this. Typically, there'll be a dotted line showing you where they are within the trading view, or if you have it in the indicators, they'll have the lines as well with the numbers attached to them. Typically, anything for long is 62 to 68. Anything above that is also quite going long here. Then we have levels of 32 to 38 for short. Anything below that is extremely oversold. The concept of oversold and overbought is debated within the community, but for the purposes of this, it makes sense to explain it here. What we also see here is that the Bollinger Bands here are tight, and when price comes out of that, there's typically a sharp move that the market makers are doing. So over here, we can see there's a lot of consolidation, and then boom, a quick hit to the downside. And then as we can see here, price then comes upwards and goes from there. Now, one other thing to notice over here as well is that you might be able to see that there is the difference in the line itself here. So the price here is moving, and then we also have the TDI here as well. Well, the TDI is higher here than it is over here. Now, for that, I think the next slide will help us understand what that point is all about. So what we have here are the entry and exit confirmation you can use. So in this case here, we have a M formation forming here. We can see the lines coming here, and then we have the 13 EMA, which closes around here. Now, what we have on this red line above and below here, this is called divergence because price over here is reaching a higher high where this is going lower. What we also have here as well is we have price moving out of the Bollinger Band. In this case, typically the first leg would be the one that does something like this. Um, this would be above the 60 because this line here over here would represent it. If I just show you the rest of the screenshot, it will show you that being above the 60. So we have price coming out of the boundary band, then going crossing the signal line, coming back in, then it comes up a bit lower and then comes down. Typically, When price does these exaggerated moves on RSI, the price itself will be something somewhat similar. So if these two were equal, then that would mean price itself would be very high in terms of the high or low points. So in terms of where to sell, over here it said that's divergence over here. Typically, when looking at that in combination with EMAs, you would wait for price to close on the EMA of the 13 EMA, this red one over here. We have the second chart candle patterns over here. Video is coming soon about that, and along as well as with the EMAs as well. So please like, comment, and subscribe um, so that I can help you guys, educate you guys on what the market makers can do, and also how you can profit alongside with them. So what we have here again is the information over here. We also have this part over here. So you would sell, and as you can see here, the RSI then crossed over the market baseline about here. If you look up price where it is, that typically is right here, where this 513 EMA candle is crossing here. So your entry could be this candle right over here. And as we come down, we can see here the price taps up right over here, and then we come back in. And what we can see here is that price comes back into the Bollinger Band here, and it comes above the 13 EMA or the signal line over here. That's typically where we can profit here, sell out, and take a profit from that point. So the sharp fin again is typically where the stop hunt will come from. And there's also other things to notice as well. So if price is just going down, 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 upwards, or going upwards in a similar direction, I've used the terms, I've coined terms, coiling the snake, and also coiling the snake upwards and coiling the snake downwards. Because typically the RSI line is going in and out of the Bollinger Band, but not actually going towards 13 EMA over there. So let's see a live example just to see all this in action. Okay, so what we see over here is that we see the EMA over here. As you can see here, I'm using gold as my example here. This is coming from um, the 8th of April. And what we can see here is that price came out and then jutted downward. So we can see a price broke through. We can see an RSI line over here. I just do this here. We can see that price broke through here. If we look to the right hand side, we can see here that price is around 40. That's also okay as well when we're looking at this. All the things that are important is the timing, typically London sections when you're looking for the higher low data form. And we're also looking at as well the levels in this case here. So the price coming out here, coming downwards, as you can see here. What we can see here, this price coming here. Now, if we just ignore the time for a moment, we can see here the price comes down here, comes across, and then make second leg over here. Now, in this case here, this shift candle closes on the 5, 30, and 50 EMA. That's a very good sign that this is going in the direction that we want, so we will take the trade over here. Now, from the RSI's point of view, what we see here is that price is somewhat divergent, but not too much. We see price here somewhat equal, and we can look over here, we see price somewhat equal over here as well. But what this does tell me is that when the price crosses through the signal line, that typically right here, if we wanted to wait for an extra confirmation, that would be when price crosses the baseline and the signal line. That would bring us up to around here. Now, where you would get in would be depending on your experience, your confidence when taking that trade there. Typically, what I would do is I would enter in on the trade around here. In this case, it's 2:30 in the morning, UK time over here. And if we measure this up, we can see that it brings us a very healthy profit of over 3,000 pips, nearly 4,000. Now, in terms of when I would get out, I typically use different ways of getting out. So I would typically have a fixed pip um, number in my mind that I'm looking for in order to get out, or you can typically use the RSI, the red signal line over here to get out. As price comes back over here and closes under it, then you can get out there as well. Let's see if we can find another one. Okay, over here, we can see here that we have price coming in through here and then price breaking out over here. Now this is Wednesday, 3rd of April on gold around 9:30 UK time. So what we see over here is we see that a W has formed. We see over here. But now what we see is divergence. We have price giving a lower low. We have here RSI giving me a higher high. This is divergence over here. Now this is what you're looking for, because now this gives you more confirmation that the market makers are going to take the price away from this area, because we already induced traders to go short. We're gathering all the stops, inducing them to go short again, and then we're closing up and going outwards. So in this case over here, we see price comes over, crosses through the signal line, and then just a little bit later on, it crosses through the baseline. Now in this area over here, that is effectively this where there's railroad track over here and opens over here. So that means entry can be right about here, and our stop loss can be about here. So it's not lower than the second leg. If you check out my other video, I do mention when you can exit and enter trades for the second leg over the MOW. In my case here, my stop loss is not below the second leg, but that's only because of the risk I'm associating with this particular trade here. It will vary depending on the type of pair that you trade as well, and your risk tolerance. So here we have here. Now we have price coming above the bands. That's fine. We're in this high 60s. Now we see price starting to go back in the band and close about here, which means if I was using this as a way to exit the trade around here, that would take me around 2150 pips, around here-ish. Or if I wanted to make it a bit more, I can drag it up here. So that's super helpful as well. If I want to hold this trade over time, all the way up to 11, then I'm able to establish around 2,850 pips, even though we see price is now equaling here, and there's divergence up here as well. So that's what I want to show you around with the TDI, the Trader Dynamic Index. It's a very powerful indicator. I've been using it for a long time, and it can help you get to profitability. So if you guys have found this video informative and helpful, please leave a like, comment, and also please help subscribe to the channel so that I can bring out more videos to help you guys become better traders and take your trading to the next level. So with that in mind, this is MTM signing out.